Markets around the world are starting to accelerate to the downside, but is this part of a bigger crash or a pullback that should be seen as an opportunity for all of us as traders and investors? In today's video, we take a look together at where we are in terms of the cycle, and more importantly, what we can expect while we have huge leaders and laggers in this particular market. Could the key actually be from this chart here? Well, let's have a look at history and bring it together with the right now, with all of the key levels coming your way for stocks, commodities, and cryptos. Guys, this will be a good one. Stick around. So welcome back everybody to The Daily Show. My name's Tom, and as always, we're going through the latest macro, the data, the lead indicators, and the hottest charts that all of us need to be looking at, whether we're traders or investors. If it's your first time here and you didn't expect a little bit of weakness this week, remember to subscribe and smash that bell icon because, of course, we showed everyone how we were seeing the market, and more importantly, where we started to see that inherent bearish weakness underneath the hood. So let's begin the discussion with where are we in terms of a cycle? Are we still bullish? Are we bearish? Or more importantly, should we be concerned about what central banks are doing around the world? Well, let's begin with the US monetary supply, which of course is something we've discussed in the previous video. The M2 supply has started to uptick here according to Charlie Bilio's chart. And basically that means that we could be back in QE. So the Federal Reserve is starting to do QE while the economy is expanding, we're dealing with an inflation crisis, and of course we've got an election year. Now, does that sound like a recipe for disaster? If you answered yes, it certainly is. And of course it eventually will come back. The question will be timing. Around the world, we're also seeing several governments give tax cuts to people. Now, hey, that's okay, I don't mind tax cuts, but at the same time, does that combat inflation crisis? Not really. In Australia and New Zealand, we've got tax cuts coming, and that is meant to combat inflation. But in the end, it will lead into further inflation. So firstly, we need to understand that on one side, we are told as investors and traders that liquidity, it's drying up. It's tight. Conditions are tight, and there's no QE around. Yet the data suggests, and has suggested for a long period, that that is not the truth. On the same side, we've got inflation during expansions that tends to last a little bit longer. So the real question, I guess, for many traders out there is, should we be terrified of inflation right now or actually celebrating it from an investment sound side? And one of the things that I guess a lot of people don't look at is, of course, yield inversion. Now, if we go from the US 10 or US 2-year versus US 10Y, you would know that we are currently inverted. In fact, we're inverted across many yield curves. Now, when that inversion goes away, that's actually when you should be most terrified. And we've argued this for a long period of time now on the channel. And what it means is that as long as inflation is kind of still around and we're not uninverting the yield curve, we're probably still in an inflation expansion. And this means that the right sectors will usually go strongly. And of course, some of those sectors have been metals and specifically things like gold and silver that we've been discussing in recent videos and of course quite a few months. So that will explain some of those things. But let's talk about cyclical bull markets in general. Are we at a point where we should be really terrified of the markets? Well, I think we're not quite there. The median duration of a market bull run is between 31 and 33 months. As many of you know, I bring this up consistently on the channel because I think it's very important to keep our eyes open to when we need to be terrified of markets. At the same time, if you look at cyclical bull markets in a different way here from Jury and Timmer over on X, cool chart, it basically shows you that we are kind of at the beginning and that we don't really see drop-offs until these particular times. So could we be going for an absolute epic cycle? Yes, but I tend to believe we're near the end, because when you start to see governments get involved in the ways they have been, central banks start printing QE even though we're expanding as an economy, that's a concern. That is a real problem. And of course, it shows that the good times keep rolling until the buck stops, and I'm sure that will happen. So what are we looking for? Well, in presidential election years, you generally do tend to see that bullish kind of narrative. And of course, a lot of people are convinced of this and convinced of the bull runs never ending. And this is what I call kind of like at the end of a cycle, you would say like basically euphoria or FOMO. And this is the point where you want to be most concerned about your investments and your, of course, bank holdings and everything else. Why? Because this is the time that a lot of people start to take leverage. And of course, we'll be tracking that in the future. And as I've promised, I will upgrade you guys or update you when I see leverage starting to get concerning. But at the point that we're at right now, it's not concerning enough. And I know that sounds wild when you see things like NVIDIA going, but it actually isn't high enough just yet. Commodity prices across the board have also been increasing, which is consistent with inflation being sticky and standing around. And a lot of people, like ourselves included, we've talked about the ideas of stagflation. But remember, stagflation will be a weakening economy with rising interest rates. So that's something we have yet to see in the US. We haven't seen a weakening economy, we've generally seen strengthening. Now, why is all of this quite important? Well, it comes back to something we brought up in our last video, the super bubble, the idea that we're going to become so weighted in a particular sector that it ends up creating a massive collapse. Now, it's most likely that this sector is going to be semiconductors. And don't get me wrong, I think semiconductors are the future. I think they'll be in everything. And I've always stated, ever since we've had this channel, that semiconductors is the best sector in the market. Now, why is it going to be important? Because if we look at the similarities to the dot-com boom, you can see here hardware, Cisco, and Intel were actually ridiculous. They went psycho in terms of industry group averages. Now, why is this? Well, this was the dot-com boom, the building out of infrastructure. Does that sound familiar? Well, if it does, you would recognize that in semiconductors and in particular, the build out of infrastructure from NVIDIA. Now, it's my thought process, and I guess a lot of you out there, that we're probably leading into a very heavily weighted market towards these particular sectors. Is that healthy? No. Is it something that's happening? Absolutely. And will you want to be paying attention to it? Yes. And I think that at the point where we end up hitting some kind of wild level, and remember, history shows us we can hit a lot wilder level in terms of percentages, then we need to be the most concerned. So what else are we starting to see? Well, it's starting to appear everywhere. Technical warning starting to crack through the NASDAQ as well, again, stating that, yes, okay, we can be bullish for a period of time, but you've got to recognize that there will be something on the horizon. Things like this don't happen for no reason. And of course, we're starting to get into the territory that we've only ever seen 3 other times. So certainly a bit of a concern here with the NASDAQ starting to show real warning signs of a super bubble on the horizon. Now, what's going on right now, though, might be a little bit different. So, of course, the core risk model here from macro charts shows that the markets were overbought last week. At the same time, we already started to see RSP, equal weighted market, all of these things start to weaken. And we all knew, okay, that probably means we need to start paying attention to a pullback here in markets. Now, will we be bullish on that pullback is the question we need to ask next. But of course, if the S&P 500, after registering a new highest high, which it did last Thursday, then falls and it goes over 1%, and of course all these other factors happen, which we have a couple of reads for, it tends to lead into a pullback. Now, is it generally minor? The answer is quite simply yes, it is. But what's most important about it is it does seem to be fairly consistent with at least a week of weakness. Now, why is that? Because you can see here 36% of the time, 10 days later, remember this read was last Thursday, where we were down and overall we only had 36% of the market. So basically, if you know your stats, about 60% of the time you'd expect to be bullish. So 36, it's quite a bearish read. Now, does that come out with some other things? Well, we always need to use the weight of evidence. Dark pool activity here, ProShares Ultra S&P, a large dark pool transaction at the most traded zone. Over the last 24 hours, we got a large trade going on in the Qs before the market proceeded to drop. At the same time, we also saw it in growth ETFs to do with the S&P 500. Now, are these coincidence levels? Probably not. And they do tend to suggest that we're getting a more significant pullback. So you can see here that all of these reads are kind of pointing towards the market, having a bit of a pullback, and then hopefully resuming the trend. But there will be some key levels technically we'll be watching. At the same time, with yields going up across the board, that's going to affect value the most, which it certainly did over the last 24 hours. And you can see here, small caps in particular fell through some of their key support levels. Just a reminder, if you enjoy our content and you want to find out more about the S&P 500 charts, we do post them over at X, especially during times of crisis like this, so that you guys can be aware of where the one-day expected moves are and everything else. So check us out, links in the description down below. All right, let's go over to consumer discretionary. As we can see here, this is a chart of basically the last 24 hours in the markets, and one of the biggest, hottest sectors of last week actually held up really well. That's the solar industry. Thanks to the government tariff stuff, they're doing okay. Consumer discretionary actually held relatively well over the last 24 hours, and gold, banks, and what you'll find out, which is of course home builders, they were dropping to kind of nasty levels actually over that period of time. At the same point, if we go to a 5-day average, you can see here semiconductors, solar, clean energy, and tech are really the only ones up, with again regional banks probably the most concerning component, and home builders being in the worst too. So certainly the sectors you don't really want to be down there were down there over the last couple of sessions. All right, let's jump on over to the S&P 500. First up, we've got our unusual activity in terms of the overall trades. And as we saw, we had a lot of negativity. We had one positive day. And then as we expected, we had two further weakness periods. So basically the net delta was negative over the last 24 hours. And when we get rid of this chart here, you're going to notice that in general, the bears were in control of the session. Effectively, there is a gap now that's placed between here. So you've got a sell there into here. And that gap is going to be very important for bulls to look at in the future. Because if we do start to fall off a cliff, let's say we go down to the 5,200 level, which we'll look at in a moment, then if we do pull back, well, of course, you'll have targets to go for, but also some important points here. Now, the Dow Jones will be a chart that we need to look at in the future, but always it's important whenever you're looking at a chart, guys, go and have a look at the actual action for the session. And you'll notice that the action for the session was mostly done in aftermarket, with the session itself opening and closing pretty much around the same kind of levels. When we look at the US 500, it becomes a little bit of a different story. And you'll notice in the futures it continues to sell off here. And maybe the futures is going to do the damage, pushing us down into that first anchored VWAP level or even that 1 day expected move. So it looks like we're probably going to open up somewhere possibly around put support. Now, put support is the 0DTE option area of 52.25. It just so also happens to be that major level of demand. But as you'll find with the Dow, because the Dow is going to show us a lot, and same with the Russell and the Aussie 200, they're all going to probably synergize with the S&P at a very similar level. So this is going to be something that we look at. If you're not familiar with how to place a trade like this, you definitely need to consider one of our courses. I don't usually talk about too much during the video at the start or the middle or anything, but this is an absolute classic example of a very easy day trading masterclass particular trade. Very replicable, and as we often say, patience, react, don't predict. The key here was to understand that you actually got two excellent entries, and they were very nice. And at the point here, they're about 2-to-1, 3-to-1 style ratios. So not too bad at all. So we've got the most trade level up here. We've got a gap fill up here, potential in the future. And of course, we have our major first support level. What if it gets worse than that though? Well, I think if the Dow in particular falls through, it could be that the market actually is going back to the general bull demand around 49,55,000. Now, hear me out for this because, of course, I'm just going to put the Dow on the chart here. We'll use the futures Dow so you guys can see what's going on. But when we look at this weekly, what you'll notice is that it could be a double top. Now, we know where our support is. It's going to be around here. So it's accelerating. It's coming back down. And we've got a slightly higher high here with MACD divergence, with every type of divergence you can pretty much put under the sun. So where is the first support? Probably around here. What is that going to correlate with? 5,200 sounds about right. I would say they're probably going to level in around the same area. So this is, of course, where the first bulls will probably sit in the markets. At the moment where we find ourselves, right here, unless it's really at 37.96, it doesn't seem to be that major level just yet. So make sure to pay attention to that. Let's now move over to the options world. And of course, we can see here that it's a sea of red. We've entered into negative gamma territory once again. And the more we push down, the more we put pressure on the hedging throughout the sessions. Notice 51.75, 5,200 now getting stacked for the Friday session. So it's clear that that's probably going to be the major put support should we continue down over the next 24 hours. From that point, notice we mentioned 49.50 before. 49.50 is now the most struck put level for the June options. So yeah, we've got kind of our key levels. I think it's clear that we can see those through the options, through the price action, and through everything else. Now let's have a look whether the CTAs agree. Well, CTAs, commodity trade advisors, if you're new here, basically systematic funds, this is usually a little delayed. They've been kind of neutral recently. You can see on the NASDAQ after NVIDIA earnings, they got a bit more bullish, but still I would say neutral. Interestingly, the gold one actually upticked while gold obviously has theoretically gone down. So this is one we'll be watching pretty closely. And Brent is all up and down and all over the place. So of course, something with oil we'll be checking out. In terms of the overall tickers, I think it's important to look at something like Tesla here because a lot of you guys like Tesla. Still trapped within the same zone, 170, 175 where all the puts are, and 180, 185 where all the calls are. So everything in there is coiling. And actually, the longer it coils, when it does break out, probably going to be an explosive move. So I wouldn't mind it just to sit inside the range, then break out, then give an explosive move. I think a lot of you would be looking forward to that. Nvidia still remains in a massive positive gamma situation. As you guys know, people are adding calls all over the place, and 1200 is currently the big strike that everyone's looking for. I wouldn't fight this at all. I wouldn't go against it. Some of you have been. That's not my kind of game, but as you'll find a little bit later on in today's video, we do see some negative overall kind of like movements in terms of volume, even though the candles are green. So something similar to what we saw in the S&P the other day with that new trading view indicator, which is interesting. Now, it's not all bad. I thought I'd bring this up. Of course, we're talking about pullbacks here, but I think we need to take a step back along with the cycle and have a look here at some of the bull market behavior checklists. Now, this may have changed a little bit, but in general, yes, markets are bullish across the board from most checklists. And you can see here Grant Hawkridge over on X's, a risk on risk off ratio, which I kind of agree with in some ways, is still continuing to go up. And of course, we're also seeing the long-term indicators still looking bullish. So I think it's important to always step back and say, look, should we be terrified or is this an opportunity? And at this stage, with the indicators that we're about to go through together, we probably have to think it's an opportunity. So the VIX jumped up, which we had to expect, especially when we saw the futures doing what they were and coming off that main level. Bonds still not really freaking out. Here's our bonds indicator with options in consideration. Not really too much freak out there. And of course, home builders continues to weaken and certainly is a sign of potential undercurrents or underbelly of the market starting to get really quite sick. Now, this will be one we watch. Of course, it is a cycle reading, realistically. So home builders, not looking too good. And again, if it breaks through these levels, could be getting a little bit worse over the next couple of sessions. Meanwhile, yields continue to climb. US 2-year going back to that set alert 5%, which is putting pressure, of course, on quite a few unprofitable companies. And at the same time, central bankers around the world, such as here, which we can see the Fed and central banks are continuing to push that there is no liquidity, but it looks like it's coming back in. So all things considered, yes, liquidity is still behind the markets, and it's one of the major reasons that we underpin this bull trend for now. Central bankers are doing anything they can to support the economy, although at the same time, the cracks are starting to show, especially in the banking institutions, being those 4,000 regional banks in the US. Consumer discretionary versus staples. This is the American consumer, has been weakening, still on support, actually held up over the last 24 hours, which is an interesting factor. And of course, the US dollar did increase, mostly because, of course, everything else fell off. Now, the US dollar is at a very important point. We talked about this most traded level. I'm, very interested in how it ends up trading. Of course, I've been a little bit bearish on the dollar, bullish here, wanting to go bearish in here. And it's back up against this level at this point. So it's going to be hard for the dollar to go bearish if the stock market is coming down. Often considered a bit of a hedge, people go into the US dollar first. Interesting point for it, still at supply, 105.20. I want to see how it interacts with that. That would probably be where I expect some sellers to come in. Meanwhile, copper falling through the daily 20 moving average, and it looks like it could be set to maybe even go to a 4.5. Now, am I concerned about long-term copper? No, not really. I think this is the trade that had to happen, and that's because, remember, the other day, not only did we think it was coming to the end of that nice bull run, but at the same period of time, we saw way too many people in it. It was a heavily, heavily traded zone, and gold and copper in particular, too many people in the trade. So we have to shake them out first. You can see here a lot of people are going through gold as a flag, which is a downward move, then a consolidation, then a break towards the downside. And I think that we're going to have some form of support probably through this bull range here, around 2280. And if that keeps to fall off, we might even be going down towards 2200. Am I still bullish? Am I still looking for 3K on this? Yes. But I think we've got to keep an open mind to this particular scenario. And you'll notice you've got a lot of MACD divergences, which is consistent throughout pretty much any of these pairs right now. But you can notice here, again, gold looks kind of weak. That's pushing the idea that dollar might be strong. But I would just say that gold probably falling down into this red box at least, minimum. Silver doing better than gold because, of course, it was playing catch-up. US oil, on the other hand, fails to make a new high, so it fails to get past $80.50 and continues to kind of give us Wyckoff vibes. So basically a false break towards the downside, a secondary false break, and then a movement up. Very tough trade zone for for oil. Up, down, and all around. A lot of people call it like a megaphone at the moment. To me, there were some excellent trades through here. Of course, positionals, you could enter into buys here for positional. And then there is that 72.50. I think we need a little bit more information on oil to find out whether it really wants to go bullish. But if it breaks through this 80.50, I could see it at 83.50 very quickly per barrel. Let's move over to NVIDIA. So as I mentioned before, the delta has actually been negative for 2 sessions now as they are green candles. Now that's certainly a question mark for the NVIDIA move. At the moment, I wouldn't necessarily be negative against it because the trend is up. But as I did mention, we've started to get signs of exhaustion. I would never fight this, but if you were to fight it, you'd have to use a put because it could easily do something like this before it comes down. Now, long-term, NVIDIA, I believe, will hit some big levels. Why? Because it's got a stock split. It's the number one hardware kind of company right now for AI. And really, that's the one that usually goes. Hardware, hardware, hardware at the beginning of any great revolution. And in this case, we are in the AI revolution, in my opinion. Let's move over to Tesla. Chop, 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 all the way through. 170 base support, 175 obviously options as well, and 180 on the upside. So the longest coils, the better the breakout's going to be. Now let's move over to the major indices. So we can see here that we talked about this in the last couple of videos, the Aussie 200 on a head and shoulders pattern, coming down to a key level where it could be finding some level of buy demand. Now we're not quite there yet, but you can see the Aussie 200 is trying its best to hold up. So it may move a little bit lower down, but this is consistent with some of the other markets. Have a look here at the Chinese market, hitting into our blue line for the first period. Now, have we seen a sign of buying? No. Are we going to rebuy this? No. Do I think it's going to go long in the future? Yes. And basically what we're looking for is that reaction. So we've got patience, now we look for the reaction. So another market that could go even a little bit lower, maybe down to 17,767. This is certainly my first level of watch and see, but then they've got the second level as well. US 2K, another one. Could we argue this is some type of head and shoulders as well on different time frames? Yes. Did it break to the downside? Yeah, it looks like it's trying to. And of course, that's angling in for further losses, maybe 2000, 1980, something like that, before the buyers really take control again of this particular market. Now, this all becomes important when we look at the Dow as well, because if the US 2K is broken down, the Aussie 200 is broken down, the S&P 500 is broken down, and the Dow is well on its way, could we be going at least to 37.4? Well, at the time of this recording, somewhere between here and here seems to be the most likely scenario. It always was. If we break below this, though, then we're talking double top theories. And although I don't think the double top would play exactly, we need to look at the length and distance. So one of the things I like to do is proof any particular pattern to see whether it makes sense to another technical level. So we can see here when we proof it out, what's that starting to show? It's starting to show really coming into this massive range. And I would argue that this is probably the most traded range through the Dow. So around that 34,000 would be very interesting, be a fib as well. Anchored VWAP, I'm sure from the bottom would something sit around there as well. So some okay levels, and this is probably about as bad as we would have to expect it to get. Again, would it still be in a bull cycle? Yes, at this point it still would be. That'd be about 13% sell-off. At the moment, the time of recording of the Dow is actually down 5 and could enter into about 6.7 before finding that much bullish pressure. Same kind of things going on around the world in terms of the NASDAQ. You can see here the NASDAQ putting pressure right on that support at the time of this recording. And again, if that kind of fails, where could it go? Anchored VWAP, watch reaction here level, previous highs, very easy to see the NASDAQ come down a little bit more. So we've got Russell 2K, Oz 200, US 30, S&P 500, and of course the NASDAQ, the strongest of the markets, holding its own for now. So that's very important there. Let's move over now to the Bitcoin market. And a lot of people have been asking, well, is this thing going to crash with the other markets? I don't think it's going to crash or fall. It's probably going to coil. And the longer it coils, the better it is for the buyer, especially if it then breaks 72. I think the most interesting level for Bitcoin is going to be 72K plus in the future. And the longer this thing coils above the 66, 65 zone, the better it's going to be for the buyer. So really, it could be the rise of the alts here, where we see a lot of altcoins start to go through. We'll bring up a chart for that in the future, so stick around for it. But I do think that Bitcoin is at the moment in a nice consolidation. So again, it could be sitting there. What figure is going to actually push this market? Well, it's probably not Thursday, but it could be Friday. Core PCE which is one of the Fed's lead indicators. That's coming out 8:30 a.m. New York. It's probably going to be a catalyst for markets. And I wouldn't be surprised at all if we find ourselves at some of these major levels of minor levels of support, I guess, before that core PCE comes through. But what do you think? Let us know in the comments down below. And as always, subscribe if you enjoyed today's content, guys, and follow us on some of the socials. Links down there. Thanks so much. Have a great day. We'll see you in the next one. Bye for now.